Folks, one of the things that we have to do right now is to stay focused on the income in our portfolios. So, we have asset allocation models for the 20-year-old all the way up to the 90-year-old. And what you have to do is you have to understand how your portfolio is supposed to work. So if you're in the 65 portfolio or you're in the income portfolio, you've built a portfolio around companies that pay dividends. And, we've always tried to find the pockets of opportunities during whatever part of the business cycle that we're in. No matter how the economy is performing, there's always going to be pockets of opportunity. So, if you're a landlord, or you've ever been a landlord, if you've ever owned rental property, you know that there's kind of two pieces to the puzzle, right? So there's the benefit of renting out that property is that you get regular, consistent income, and you can increase your rent, the rent that you charge on that, as inflation increases down the road. So the most important thing to you, if you own a piece of rental property, is most likely, are you getting regular rental payments from the person who's occupying your property? Now, the other piece of that is the value of the property. Now, if you own real estate, you probably don't look every day at the value of your property. Could go up, it could go down. If you have a renter that leaves it in really bad condition, then the value of the property could go down until, of course, you put more money into it and get it fixed. If the real estate in your area, maybe it's a part of town that has deteriorated, the value of it might decrease. But the thing that you're still focused on is the income in it. And that's how we have to look at our portfolios right now, because I believe we're going to see more downward pressure in the markets. We're already down 20 to 30%, and I would not be surprised at all to see more weakness. I mean, in a few weeks, we're going to enter into earnings season for the third quarter, and I think we're going to hear a lot of bad news. That's going to put more downward pressure on the market. Every time the Fed does what they're doing, which is to increase rates, and I think they've telegraphed pretty strongly that they're in a tightening phase, and they're going to continue to do whatever it takes. They've said that there's even going to be pain in all of this. So, there's lots of predictions out there. If you want to, I'm sure you probably heard some if you watch the financial news, predictions that the S&P will go to 3,300, 3,200. I've even heard one prediction that it could go as low as 3,000. So in the short term, we never know what's going to happen. We never know what geopolitical event is going to happen. Nobody could have predicted the pandemic that we went into in 2020. So there's so many things in the short term that could impact and where the market goes. And I don't want us to get too focused on that, because, we can really get ourselves in a lot of trouble if we start to abandon what is a good, solid plan. Then you have to be right twice. You have to be right about when you get out, and you have to be right about when you get in. Statistics tell us that for those that got out during the financial crisis, as of a couple of years ago, 30% of them still weren't back in. So, the last 10-year rolling period, I believe the last 10 years in the S&P 500, we've seen an average of 14% returns. Now, I expect that to moderate going forward just because of where we are with inflation. The economy is weakening. We're seeing it's a worldwide phenomenon. It's not just happening in the U.S. And I believe that it is because money supply has really outpaced goods and services. So, the increase in productivity and all of that. So we've got way more dollars out there, not just in the United States, but in the world, chasing those goods and services. And until we get that under control, we're not going to solve the problem.